There's no shortage of information that can impact the way you invest. And I'm here along with my guests to get to the important part. I'm Liz Thomas, host of The Important Part, Investing with Liz Thomas. As head of investment strategy at SoFi, I share insights and perspectives that cover everything happening in the world of money. Now let's get to it. My guest today is Brian Belski. If you watch CNBC, Fox Business, or Bloomberg, you probably know who he is. And if you don't, you're about to find out. You're also about to find out about his famously positive view on markets, which is so positive, in fact, that reporters often introduce him as Bullish Brian. And he's a fellow Midwesterner, which I also love. Brian is Chief Investment Strategist at BMO Capital Markets and leads the investment strategy group. He's been in the industry for nearly 35 years, and he advises institutional and private clients on portfolio management and investment strategies. Previously, Brian held senior positions at Oppenheimer & Company, Merrill Lynch, and Piper Jaffray. Brian, welcome to The Important Part.
You know, it's humbling to be important, quite frankly.
It is humbling. It is humbling, yes. Okay, so here's what we're going to start with. This is the big news that you had mid-September, and a big reason why I wanted to have you on the pod. So we're going to talk about strategic mindset and outlook, but this bold prediction that you made in September, you were already pretty bullish on markets, but you revised your target, your S&P price target, up to 6,100 by the end of 2024, which made you the highest target on the street. And for context, as of this recording, the S&P is trading at about 5840. So talk to me about the resiliency of this current bull market and that price target move.
Well, thanks for having us, first off. You know, when we wrote our year ahead piece, Liz, in November of 2023, we initiated a 5,100 price target on the S&P, and then we moved to 5,600. Even the 5,100 is like, oh, here we go, Belski again. Here we go.
Yeah.
Bullish.
He's unhinged.
Yeah, unhinged. But as we said in the piece, we reserved the right to change this because we thought, and we knew that we weren't bullish enough in 2023. For our part, 2022 was a rough year, man. The macros had it. We thought the unwind of the negativity, quite frankly, would happen faster. And thankfully, we pivoted pretty hard in June with the portfolios that we run. So what's kind of different about us is that there's a lot of things, but what's different about us is that we actually put our money where our mouth is. So we run 10 separately managed accounts and 2 ETFs for the broader BMO Financial Group family. And, you know, the first 6 months, man, talk about humbling. I really think in this business—
First 6 months of 22?
Of 22.
Yeah.
So I'm building up to why we're so bullish. So it was so humbling because, you know, when you're wrong, you're losing people money. And I think a lot of people that do what I do, I probably never sat across the table from a client you've lost money for. Maybe like an institution or something, but then again, you know, that's not really losing money, because if you're losing money for Mrs. Thompson from Winnipeg, you know, they're probably not going to come back to you. Mm-hmm. And, you know, I always say, you know, God asks you to do a lot of things, but should always act justly, love mercy, and walk humbly. You need to walk humbly in this business. And don't ever confuse cockiness with conviction. We've always had conviction in every call that we've made. So we pivoted hard in June. And then when we wrote our year ahead piece for 2023 and in November of 2022, we said a new cyclical bull market has begun. Nobody believed us until the market was up 20%. And then the academics and the books were saying, oh, the market's up 20% in a new bull market, which I think is a bunch of crap. I mean, that's just lazy reading and lazy writing. And so the bull market, we had year one of the bull market in 23, year two of the bull market this year. Now we've entered into year 3. And so what you're probably going to hear us talk more about as we write now, I think it's my 26th year ahead piece that I've been the principal author of, and the 13th at BMO, that I think the bull market's still alive, Liz, but I think it's going to slow down a little bit. So what led us to 6,100? A lot of people think it was the Fed, and it wasn't the Fed. We actually wrote the piece the weekend before the Fed came out, and to us, it didn't matter if it was 25 or 50. What mattered more to us was the train is going to leave the station. And so after a prolonged period of raising rates and then a prolonged period of doing nothing, We saw the Fed pivot here as an important one, especially as Powell, who's received so much negativity about how he's handled this.
Yeah.
I think he's actually done a pretty good job.
I do too.
Let's show someone some mercy. I mean, I go back and I remember talking about the dual mandate when he pivoted hard and even harder in August of 2020, and really started talking about the dual mandate of employment and inflation. He's still managing that. And so I actually do believe he's going to get us down to that 2% number for inflation. Be that as it may, train has left the station, and we have now
the cutting train, you mean?
The cutting train. And we have now reared an entire generation that believes you only buy stocks because interest rates go down. However, we are already in a big bull market. Stocks are going up and interest rates are going up. So I think what all of this means is, believe it or not, we're heading into normalcy. We started talking about this 2 years ago. So what's normal? More normalized returns. Certainly none of this up 25%, down 25%, these weird earnings numbers, these weird valuation numbers. I think we're going back into kind of a mid-90s environment, stock picking, themes, fundamentals, high single digit, low double digit returns. Same thing for earnings growth, Liz, 3 to 4% 10-year treasuries. I think that's a really good environment for stocks. And I think where the money's going to come from actually is out of fixed income still, out of cash, because there's a lot of cash on the sidelines. And dare I say, this is controversial, is out of private equity.
Okay.
So I think that's where the money's going to come from. I still think we have 10 years left in my big call. In 2008, I was at Merrill Lynch and I said, we're entering a bull market. In 2010, I was at Oppenheimer and said, we're entering a 25-year secular bull market. I still believe that. I'm not being stubborn. I really, really believe it. 2009 was the generational jump up and down time to buy stocks. And since then, Liz, we've had a few bear markets and we've had a few bull markets. And so as part of this big secular trend, I think we have a ways to go.
Okay. All right. So let's focus on this particular price target move. I remember not too long ago, I don't know the exact date, but I believe we were on set together and it was before the show.
Yep.
And you said to me, I think we're going to see a 10 to 15% correction before we then rise into the end of the year. And it's possible that price target gets changed, right? So if I look back at the year so far, we had a correction in April that was 5%, late July to August 5th, that fateful day on August 5th. That correction was 8.5%. And then we had another little cute one in September that was about 4%. So we never had that 10 to 15%er, yet you raised the price target after that. What changed? What made you feel like we're not going to have that 10 to 15%er anymore?
Well, I think it's a great question. I coulda, shoulda, woulda done it in August, but I don't like making price target changes in August, given the traditional volatility that we see in August. That's number one. Number two, you mentioned the term cute. Sometimes, I mean, I've never been accused of being cute. Let me just be very clear about that. But I think sometimes we try to be too cute, and and I wanted that pullback, and I didn't get it. So you know what? Let's do it. Let's up the number, because if you think about sitting at a 5,600 target where we're at, and the market was almost at 5,700.
Right.
What value are you adding by saying, I think the market's going to close at 5,800 at year end? You're not adding any value.
Well, you're basically saying it's flat, or you're saying it might actually come down a little bit for the rest of the year.
Right. So we actually believe that earnings are a little bit better than most people think. We might eclipse that 250 number, but I do ultimately believe that there's more money coming in. And we've seen a broadening out of the market, which we've been calling for all year long. And we were the first in published print talking about small mid-cap stocks, so we received a lot of crap for it a year ago. But at the end of the day, we think stocks are higher. We're at new highs. By the way, I'm probably going to talk about it, but I think everybody's so sick of this election stuff. As soon as this is over, market's going up, regardless of who wins. Let's just be done with this, and markets are going to go.
No, we're not going to talk about the election because I'm tired of it too. So one of the other things, and this is a little personal, right? Because I am a macro strategist. You talk a lot about being a strategist, not an economist.
Oh.
So first of all, and we've been on a show together before where I think you've said people are getting way too bogged down in the macro. Don't pay attention to the macro. So take us through how you view the stock market versus maybe how you would see being an economist, how an economist would see it, or maybe even somebody like me, right, where I am talking about the stock market, but I'm looking at it through the lens of here's what's happening in the macro. Here's how that can inform what happens in capital markets. But I also am not an economist, but I do talk about the macro much more than you do.
This is my 35th year on Wall Street. For those of you that don't know the saying, I'm the Doogie Howser of Wall Street. I started when I was 8.
They probably don't know who Doogie Howser is.
That's what I'm saying.
Either.
For those at www.google.com, look it up. So I'm part of a lost and restless generation. That's a line of a movie Stripes, Bill Murray said. And why I say that is a lot of people that do what I do don't do it like this anymore. This is the way I learned the business a long time ago. Most people have become more macro and become more quant in their strategies. And I think that was derived, quite frankly, from the bubble in 99-2000. Because in 99-2000, analysts were rock stars, investment bankers were rock stars, strategists were managing money and stock lists and stock jockeys. So everyone took stock in literally these strategist stock picks, where it all blew up, and then confidence waned big time in analysts. So what happened was strategists went, I'm a macro person now. I'm going to look at macro data and I'm going to become a quant. I'm going to model out consensus numbers on FactSet or CompuStat, and I'm going to come up with my own models with respect to the double underline what I should look at a company. And then everybody kind of forgot about a company fits into an industry, fits into a sector, making sector calls, and then the proliferation of ETFs. Let's make a call on the market, meaning it's a spider or a diamond or the Qs and all this kind of stuff. And so as you can tell, I didn't answer the question on The Economist, but someone told me once I'm really good at not answering questions. But my joke about economists are economists get paid for being wrong, just like a weather person, right? Weather people are paid for being wrong. And the greatest thing about economists is, I'm revising my forecast. Well, I can't revise my forecast. I can, but I'm going to be out of a job. If I continue to revise up or down, no one's going to have any confidence in what I do, especially because I do my job differently. And again, how I do my job differently is I have fiduciary responsibilities. I run this money. You can't be buying and selling stocks based on a whim. So my big joke about macro is you don't buy CPI. CPI stock, or is ISM a stock, or is...
You can't invest directly in the macro.
Correct. Yeah, so the other thing too is that macro already happened, right? So you reply, GDP for the third quarter. Well, I guess we're going to revise it 3 more times. By then, the market, we're going to be 6 months later from that. So I think that's sometimes the trap that we get in. Can it be a guidepost? Absolutely. Is it part of my models when I market out and model out the stock market? Absolutely. CPI, PPI, WTI, employment numbers are part of my macro model for the S&P 500, but I use 3 different models, and then I use the median of those 3 models. So I have as we like to say in Canada, even though I'm from Minnesota, process for all you Canadians out there. We actually have a process in terms of how we look at markets, and we've been doing so since the 90s.
Speaking of the 90s, you mentioned it a little bit at the top of the show, but let's go back and talk about history, because there have been endless comparisons with this bull market to that of the late 90s heading into the 2000s. There have been comparisons between Cisco and NVIDIA. I mean, it goes on and on and on. So you mentioned, though, we're entering a period of normalization, which I think many of the comparisons, at least for a lot of bulls to the 90s, end up being, we've got so much more room to run. We're not nearly as extended as we were then. AI has changed the playing field entirely, and this is just the beginning, maybe the 3rd or 4th inning or whatever they're using as the comparison of this run. Yours sounds different. If we're normalizing, that means we're actually slowing down some of those expectations.
The way that I've said it is, again, you can Google this, Gen Zers and millennials. Think of it as Madonna song Borderline meets Kurt Cobain and Nirvana, Lithium. Right? So what do you give a person with borderline personality disorder? Lithium. So it's like 1983, 84 meets 95, 96. Okay. Boom. It's not 99, 2000. Here's why this drives me actually crazy that we're 99, 2000. No, we're not. In 99, 2000, let's go back to what I said. You had rock star strategists, rock star analysts, rock star bankers. Everybody was getting rich in 99, 2000. Who's getting rich now? Technology. Are financials getting rich? Are we having this big banking cycle? Do we have investment banking? Are we seeing M&A deals? Absolutely not. We're not. And so that's the major difference in terms of, you can't use the term bubble just because asset prices are going up. Bubble means excess. Bubble means froth. Just because a stock goes up doesn't mean it's froth. In terms of NVIDIA versus Cisco, I remember stocks like SLR and JDS Uniphase. We're gonna measure the company based on billable people walking down the street. I mean, that's the kind of stuff we were talking about in 99, 2000. Let's throw them some money. And the majority of deals were getting done with stock, not cash. NVIDIA is not
that's
Cisco.
True. That is a big distinction, though. It was stock, not cash.
Here's the other thing, too. I remember back, again, I'm old enough, then John Chambers, again, rockstar CEO, used to come on CNBC and the stock would go up. Jensen at NVIDIA, he actually is a quite humble dude. He is quite humble. I mean, he looks cool with the leather jacket and everything, but his technology is unbelievable. Not to see that Cisco wasn't, but I think the AOL thing is a much bigger story of the bubble than Cisco. Cisco's still around, by the way. Oh, by the way, Cisco could be termed a value stock now within tech.
The chart is pretty amazing.
Yeah, so I don't think that it's 99, 2000. I think it's 95, 96, where it was stock picking. And it was the Nifty 50. Greenspan's famous speech about irrational exuberance, many people automatically think it's about tech. When you think about tech, it's kind of like disco in the 70s. Everybody thinks that the 70s were disco. Disco wasn't until like 78, 79, in late parts of 77. It's just like tech was not big in the markets until late 97, 98, 99. So in 95, 96, it was the consumer staple stocks. It was Coca-Cola, it was Procter & Gamble, Gillette, GM, GE was the old saying was, as GE goes, so goes the market. When's the last time you heard that?
Yeah.
You don't hear it anymore.
It turned into Apple. It turned into as Apple goes, so goes the market. Now it's as NVIDIA goes, so goes the market.
Correct. And so as a strategist, even back then, it was hard to be liking any of those names because of valuation, but you absolutely positively had to be recommending them and talking about them. Otherwise, you would be left in the dust. And so I think going forward, our view on technology is this, and we've said this now for about 10 years, is that we believe those big brothers and sisters in tech, what if you want to call them the Magnificent Seven or whatever, are the new consumer staples. They're the new consumer staples. I mean, I'm willing to bet every single person in this room has an Apple device on or near their person. And,
maybe multiple.
Yeah, and they're bored by this comment right now that I'm talking, so they're actually shopping on Amazon. Or
they're all laughing. So we busted at least a couple.
Figuring out what new thing on the Netflix machine to watch. Those are your new consumer staples, and then this new emerging talk about CapEx and AI. Part of AI is Palantir and Qualcomm and AMD and Broadcom, some of these other names, and Oracle, that I think are going to be the real kind of strength and growth on an absolute and relative basis for the next 3 to 5 years.
For everybody listening, if you're not familiar with consumer staples, typically companies, you can see them in the food and beverage industry, the things that are not negotiable that you buy for your house, paper products, companies like Procter & Gamble.
Campbell Soup, like in a few weeks, we're going to be going down aisle number 4 at Piggly Wiggly, and we're going to be buying...
Piggly Wiggly. Nobody outside the Midwest has any idea what Piggly Wiggly is.
We're going to be going down Gristedes in aisle number 3, and we're going to see that can of Campbell's cream and mushroom soup because you're going to make that crappy green bean casserole at Thanksgiving. You buy it once a year.
Yep.
Soups and Campbell Soup, General Mills, Kimberly-Clark, those are consumer staples. But if you think about it, the names that I mentioned, those got us through COVID.
The tech names.
Yes.
Yeah.
Right?
Yeah.
If it wasn't for those names, I mean, I remember it was so exciting in my condo in Minneapolis when the guy would knock on the door. It was the Amazon guy dropping out the brown box, and you'd run to the door to see a human being. Remember those days? Knock, knock, whoo! And so those are your new consumer staples.
If that's the case, my question is about concentration in a portfolio. So first of all, do you still hold the traditional consumer staples? And if we have big tech as the consumer staples of a portfolio, then we probably also have more tech exposure in whatever we would consider straightforward tech. Then there's all kind of adjacent tech names. So at some point, the whole portfolio is skewed towards tech or somehow exposed to tech. So are we now too concentrated in that one particular sector or theme.
It's a great way to think about it. So if you think about like AI, one of the best AI stocks is Costco.
So Costco, the last big news on Costco was that they're selling bricks of gold. So how?
Because, so technically Costco and Walmart are consumer staple stocks.
Correct.
And so those are the names in the technical consumer staples sector. Those are the names we own. For my tactical and kind of longer term growthier money and more value money, I own like Altria and those types of names, high dividend yield type names. But at the end of the day, like Costco is using AI to, when you walk in the door, they know exactly where they're going to be telling you, they're going to be sending you messages because based on your buying history, you're going to say, oh, you were here last time, you're going to go down aisle number 4 and you get those cases of Diet Mountain Dew. They're on sale.
Yeah, that's terrible for you though. Don't drink Diet Mountain Dew.
I know I used to when
sparkling water is better.
When I'm so listen, you and I from the Midwest.
Like yellow number 5.
You and I are from the Midwest, so I call it pop, right?
I call it soda. But let's go back to something like Costco, because I think this is important. So we talk about AI all the time. I think the names that we relate with AI are obvious, right? The
Apple,
semiconductor
Google,
names, all of it, everything that's tech. But then you've got a company like Costco. You can choose another one as an example too. I think our SoFi members are onto this because Costco is one of the most widely held stocks on the platform. So obviously they understand a little bit about how it's playing in the AI space, or maybe they're just really into buying in bulk. I'm going to guess that it has more to do with AI. But talk about maybe how a consumer staples company can use AI or is already using AI, because I think this is a little bit of a misunderstood piece. And there's a lot going on in the market today about, okay, AI was this huge theme that came out. Everybody had these huge expectations. It was supposed to create profits by the end of this year, and perhaps that hasn't come to fruition yet. But it's because we don't see it yet, and it's hard to make those connections. So Costco or whatever other example you want to give.
Whether or not it's Costco or McDonald's or Starbucks, inventory type measures, buying patterns, personal stuff, financials and banks are going to be a huge thing. I don't know if SoFi is doing this, but I know a lot of the banks are. When you walk into a branch, now you don't have physical branches, right? But think about when I walk into a physical branch at Bank of America or JP Morgan or Citigroup. There's technology out there that's being tested, and it's all AI. Remember, financial services are some of the largest purchasers of technology traditionally, and they've been there for 5, 6, 7 years working on AI, where you walk into the branch, Liz, and they'll know exactly what language to speak to you
without you saying anything.
Without saying anything. Wow. That's AI.
That's crazy.
It's crazy, right?
Yeah.
So that's one example, but I think for the consumer side, it's just early days and can be ramped up, whether or not it's an airline company or a hotel or restaurants. I think for the traditional retail side of it, you're going to see faster implementation of it. And that's why, like Costco, I think is a great example of that.
All right. Something else that you've said recently, this is kind of the last chunk. I know you talk a lot, Yeah. Something else you've said recently is that we're entering, or that we are maybe already in, a stock picker's paradise.
We are.
So here's what I want people to understand. Number one, what makes this environment a stock picker's paradise? Number two, what are the elements that you're looking at to pick those stocks, particularly in this environment?
So I think it goes back to the macro side of things. People love to make market calls, love to make sector calls. They're less comfortable making stock picking calls. So I grew up doing this 35 years ago and learned the business. My very first mentor was William O'Neill at Investors Business Daily. And he's known as being a technician, but he's a closet fundamentalist. And I remember I was there a week and he came over to my cubicle at the time and he said, Belski, I hear you're from, I can't do his drawl. He's from Texas, but Belski, I heard you from Minnesota. Let's take a walk. And he walks me over to ladies and gentlemen, kids, there's this thing called a filing cabinet and a file. And he pulls out the file. And the file was MMM. It was 3M. And MMM stands for Minnesota Mining and Manufacturing. And it was about this thick. So you can't see me. It's about 4 inches thick, 5 inches thick. And he said, okay, Belski, you had an hour. Let me know what you think. So I had to pitch the stock to Bill O'Neill. So I quickly read the company annual report and the 8K and the Qs and looked at their earnings stream and their value stream. But I really spent a lot of time on company management and their product and service and their longevity and their track record of being successful. Post-it notes, tape, Scotch tape.
Yeah.
There's this thing called Scotch tape, plunger pens. Anyway, and that's stock picking. So I think in this era, Liz, of reading through scrolling this way or sideways, nobody reads anything anymore. It's really difficult. And I think this era of investing that we've become so macro, we're so afraid to be wrong, we don't want to be right. Whatever this XYZ firm is talking about this stock, and I'm talking to my salesperson, he's pitching me this stock, it must be something to that, right? If my salesperson at XYZ brokerage firm keeps on calling me about the stock, and I know at ABC Wealth Management they're talking about, or this hedge fund this, I'm going to do that because I don't want to be different. It's too much risk to be differentiated. Where I'm seeing in terms of my math part of it, Liz, is there's this called dispersion. So we're seeing massive dispersion in terms of price performance. Price performance is all over the place. And you want to be a stock picker in that environment, I can take advantage of that. So if here's a great example. As an investor, I like the drug industry. So I'm going to buy the DRG ETF. You are hurting your performance, because you are diluting your performance, because in that ETF, you might have a crappy company. Like I know one of our mutual friends likes a stock called Pfizer. It's been a massive underperformer this year. It's in the ETF. In fact, it's one of the largest positions in the ETF. That's stock picking. Another great example would be, so everyone's saying, you need to buy small cap, mid cap. Well, we have the good fortune of running what we call a SMID portfolio. So it's a combination of small and mid cap. It's benchmarked against the S&P 1000, which is the S&P 400 plus the S&P 600. And so that index is up 18%. Mm-hmm. My portfolio is up 40.
Wow.
And here's why. Because I pick stocks. We love the product. We love the company. We love the vision. They have an operational issue there, so I think they'll fix it. We had in that portfolio originally a stock called Spotify. We bought Spotify when it was a $10 billion company. Now it's a $100 billion company. We graduated it to our large cap portfolio. So I'm just not going to go buy an ETF or buy the Russell 2000. I'll outperform the Russell 2000 by just looking at stocks the way that I look at stocks.
So, fun fact, when I was an analyst at Baird, one of the asset classes I covered was SMID, and I loved it. So I have a soft spot for SMID. And for everybody listening, if you don't know what SMID is, it's obviously we're combining two words, small and mid cap. So when stocks are small cap, if you're an active manager, a stock is a small cap up until about $2 billion, and then you sort of get graduated out of it. SMID usually goes somewhere between, what would you say, 2 billion and 5 billion-ish. You can sort of drift up to 5 billion, and then mid cap goes up to, let's call it 12 to 15 billion, and then large cap is anything above 15-ish, right?
Yep.
This is arbitrary depending on who's defining it. But the thing about SMID that I used to always find attractive was that there's a lot of non-profitable companies in the small cap indexes.
Not as much as there used to be.
Not as much as there used to be, but they're still there. So if you buy a small cap ETF, you get a lot of junk in there, unless it's going through another screen for profitability, which some of them do. SMID allows you to cast this wider net, and it allows small cap companies to graduate, right?
Correct.
You don't get pushed out of them because they've gotten too big. So it allows them to graduate, and that's what you want to happen. I used to cover a manager that would call them the next generation of blue chips, because if you think about it, that's the ideal process. It starts as a small cap, then it moves maybe into SMID, then to mid, then to large. That is like the success story that we're all waiting for. So you want to catch it. But SMID is that little sweet spot of you're catching it after it's become profitable. It's got at least some legs to it, and then you can watch it grow the rest of the way.
Yeah, that's when I wrote in my piece, and I talked about how I love it when your kids grow up, right? Mm-hmm. So DoorDash and Spotify, we moved into our large cap portfolio, but no other time in my career have I seen free cash flow yields, earnings discernibility. What does that mean? The clarity of earnings, that they're real earnings. And the revisions have actually, in terms of revisions, mean as an analyst, upping or lowering their earnings estimates going forward, and they're really becoming more and more solid in small mid-cap land. Lastly, I would say from a dividend perspective, Liz, there's a lot of companies in the mid-cap world that are paying dividends. But lastly, I'll say this. This is a cool statistic. If you had $100, right, of public, and that represented the publicly traded market cap space of everything in the United States, right? Small mid-cap represents $7.
7 of 100. Okay.
That's NVIDIA, when NVIDIA was at its peak.
So the entire asset class represents what can be one stock in the large cap space.
Yeah. So when I say that to people, they get nervous.
Yeah.
That to me, it excites me.
That's
Because
an opportunity.
Yeah, you can have something called tracking error,
Yeah.
where you can be much different. Again, you said, I think differently. Well, yeah, I mean, this is a way to be different relative to everything and everybody else.
So how would you, if you were an investor who doesn't have enough money to invest in a separately managed account, those usually have high minimums, you don't want them to buy a broad SMID ETF, how would you suggest somebody try to start getting into that asset class?
I want to clarify something. Even though he said in bullish Brian Belski, I think the biggest call that I've ever made was a bearish call. We can talk about that at the end. But I was very blessed and fortunate to meet this gentleman. Maybe you've heard of him, Warren Buffett. And it was 6 months in the business. And I had like 5 or 10 minutes with him. And he said, Belski, never buy anything unless you can reach out and touch it. And so if you are an individual investor and you have your account, you have a direct investing account or something like that, buy something that you know. Reach out and buy stocks that you own. The same rule.
And the stuff you use. Yeah.
Right. The same rule actually works in large cap, but in small, you can use it in small cap. Buy the stuff that you know and reach out and touch and understand.
Amazing. So, okay, that's the end of the regularly scheduled program.
Oh, good.
And then we've got a couple segments.
Okay.
So quick answers.
Okay, hit me.
So, and it doesn't have to be one word, but it should be quick.
Because I talk a lot.
The first one is called the word. So sum up your market forecast in one word that isn't bull or bear.
Doubted.
Doubted? I did not expect that word. I thought it would be something much rosier.
No, doubted.
Like rosy.
This is I used to say this is the most hated bull market in history. This is the most doubted.
Yeah.
Every time the stock market goes up, everybody wants it to go down.
Yeah. You covered this a little bit, but this one is called the aha moment. When everyone else was warning of a recession in 2023, was there a moment where you realized that's not the right call? This is when we turn bullish.
In 2023?
Yeah.
We actually did it in 2022. And when we had a really lofty target for 2023. But I would say my aha moment in 2023 was I went on vacation the first week of January, and I rarely do that.
You told me this story.
Yeah, so I'm all of a sudden tech stocks were like rocketing, and my phone's going off because I was long tech. I was overweight tech.
Yeah.
Like, Belski, why are these tech stocks working? And I'm like, people didn't call me all during 2022 because I was so wrong. All of a sudden, like, what? Something's working now. Like, I have to talk to Belski. Why are these things going up? That was the aha thing. Like, this thing has legs. Because that really told me that nobody was there in tech.
Okay.
Like, nobody. And that
so
was
positioning.
It was positioning, but it was January 2023. And by the way, it took all year for people to get into tech.
I know. You were wrong in 22. I was wrong in 23. I'll take that. All right. Last one. Best or worst trade. Now, this doesn't have to be a particular trade, but share a lesson or two from your early investing years that now still informs the way that you make decisions.
So I was a young analyst, and I was technically a technical analyst for the first part of my career on the sell side at a place called Dane Bosworth, then became Dane Rauscher, then I was Royal Bank of Canada, came in and bought it in Minneapolis. And part of my job was I talked to retail brokers all day long, but then I'd have to do the morning call sometimes. So my boss at the time said, write up the note today, and I wrote up the stock called Biomet, BMET. And they're an orthopedic company. And I did the research on it, and the stock was breaking out, but I didn't really know as much as I should. And I went on the morning call and I told people to buy the stock. Well, 2 days later, it was down 25%.
Ooh.
And guess what I did? I did something that most people don't do. I went on the call the next day and I said, I'm so sorry, I made a mistake. But that moment will live with me the rest of my life, because it goes back to the humility part. You have to have humility in this business, but it rocked my world that I was that wrong, because guess what? I didn't dot the I's and didn't cross all the T's that I should have, and I learned my lesson. But I reversed it really quickly by going on the morning call the next day.
Okay. Awesome. Well, bullish, Brian. Whatever, Belski the bull.
Can I quickly tell why
I call you Belski the bull.
Can I quickly tell my story about what my biggest call was, the most bearish call?
Oh, yeah, please.
So I was at Merrill Lynch at the time, before it was stolen by the evil empire. And I was head of U.S. strategy, kind of, but I was mostly U.S. sector. And my job was to make the calls in the sectors, right? And Rich Bernstein was chief investment strategist. He had the market call, even though I was doing U.S. stuff anyway. So I'm in Vancouver, and I was getting really worried about financials. And this is August of 2007. And back then we did pair trades. So you went long a sector, short a sector.
Okay.
And I let off the morning call every Monday and say, okay, we're going to buy this sector, sell this sector, buy this industry, sell this. And then here's my list of stocks. And then they do a structured note, or they do like a wrap product. Anyway, so I was getting really worried, and I was in Vancouver seeing accounts, and I was, screw it, man, I'm going to make this call. So sell financials, buy tech, August of 2007.
Wow. So
I wrote the piece, I was in Vancouver, got up at 3:30 in the morning to be properly caffeinated for the 4 a.m. call in New York, let off the call, think financials are in trouble, sell financials, buy tech, worked for an hour, and then the Fed essentially began QE that day. And basically going in and doing what they're doing in the open market. So financials are up 4%, Margo's up 2%. I remember the research director calls me and said, "What the are you doing, Belski?" And I said, "Please turn to page 4, exhibit 3. What do you see?" She looks at it and she goes, "I got you, Belski," hangs up the phone. So that was the call of my career.
What was on early. Page 4, exhibit 3?
Financial stocks became disaligned with interest rates and more aligned with credit spreads. And equity people were not talking about credit spreads back then.
Yeah.
I'm like, this is a problem.
Yeah.
And it scared the crap out of me. So the relative performance of financials relative to credit spreads. And again, nobody was now it's become very sexy to talk about credit spreads, especially after the great financial crisis.
They're so tight, though. Anyway, okay.
After the blowout of 2008, 2009. So that was my biggest call in my career, is actually a bearish call.
It was a bearish call. I bet most people would not know that about you. All right. That's a wrap. Thank you so much for joining us.
Thanks,
I am
Liz.
sure that our listeners enjoyed it. Okay, so a few takeaways. There were many takeaways from that episode, but a few that really stood out to me. Obviously, he still thinks that the bull market has legs. Maybe not at the same clip that it has gone for the last couple years. He talked about a normalization, and a normalization being mid-single digits, maybe upper single digits in returns. Now, we've been used to double-digit returns for the last couple years, but I think it's important to note that a bull market can still be a bull market even if it's smaller numbers. Second big takeaway, when he talked about meeting Warren Buffett, obviously that's a monumental piece of anybody's career, but when he talked about meeting Warren Buffett and Warren told him to buy things that you can reach out and touch, and then we started discussing also buying things that you like, things that you use in your everyday life, and that may not be an entirely new concept to many, but it's a good reminder nonetheless. And then the last thing that he was very convicted on is that we are entering, or we are already in, what he called a stock picker's paradise. So this is a time when basically the dispersion of returns is very large. So the difference from one stock to another stock, one sector to another sector is very wide, which makes the environment ripe for choosing individual stocks and being more specific about where you're investing. So thank you for listening. We are so excited about this episode and very excited to be bringing you the next episode soon.